And we should be live. Welcome to Zero Hedge Debates, folks. I'm Adam Taggart, founder and host of the financial podcast channel Thoughtful Money, and I'll be your moderator for the evening. Tonight's debate topic is the post-Iran war economy. Hopefully a negotiated resolution to the Iran war happens within the next few weeks or month. But if indeed so, well, folks, what comes next? What will happen to the price of oil and other key Gulf commodities like natural gas, fertilizer, and helium after the Strait of Hormuz reopens? Will they plunge, or will the damage done so far to world trade keep prices elevated for longer than many expect? What about the economy? Will it be able to shrug off the effects of the conflict, or is there a wave of demand destruction that can't be prevented at this point? Is a recession likely or not? To unpack for us, we've got the great good fortune to be joined by money manager Michael Pento of Pento Portfolio Strategies and researcher Adam Parker, CEO and founder of Trivariate Research LP. Gentlemen, thanks very much for joining us this evening.
Yeah, thanks for having me.
Great to be with you guys.
All right. Well, look, I know Michael Pento very well from having interviewed him on my channel over the past several years. Adam Parker, you and I are meeting for the first time here. Very excited to get to hear your insights here. As I told you before we get on here, it's a little weird for me because my middle name is Parker, but I'm somehow going to get used to that. So we're going to talk for the next hour or so. We'll hold to that loosely in case this conversation wants to go a little bit longer and you gentlemen can still stay around. If so, we'll try to take a few questions from the live audience, but I've got a bunch of ones already prepared for you here. And let's start with the top one here, which is assuming that the Strait of Hormuz opens tomorrow, how severe is the damage that's already been done? And when do you think it'll show up in the economy? Adam Parker, since you're the new guy here, let's start with you.
Well, it's funny. I really don't think much about the economy. So, meaning like, all right, I'll go a little crazy and say, I don't really think economists know what already happened, forget what's going to happen. So I don't really rely on economists. When I worked at Morgan Stanley, there were 44 economists working there. I thought the correct number they should have was a lot closer to 0, maybe like 4. So, and the reason I'm doing that, I say that is like, I think 30 or 40 years ago was a very respected kind of Bachelor of Science degree. But now I think it's, I can use, any of the basic, kind of AI tools to get a summary on the economy in 1 second and get facts. And then 2, the correlation between the equity market and stock returns. I mean, the stock market predicts the economy, not the other way around. So I don't really think, I think economists should be using stock prices to predict things, not the other way around. And then lastly, like economics and stocks are completely, economists want to raise their GDP. So they want higher capital spending and lots of hiring so they can raise their GDP. But I mean, I'm sure Michael will tell you if he owns a stock and they surprise him with tons of CapEx and tons of hiring, he's probably not super excited about the margin profile and the multiple. So I don't really think about the economy. I'll take the tenor of your question of like, where are estimates more achievable and less achievable because of sustainably higher oil? And when will that appear in the earnings and revisions? And in that light, I'll say I'm most negative on staples and discretionary consumer, where I think, and select industrials, where I think there's just going to be rising input costs that aren't in the prices. And I think stocks go down when they miss. Our biggest observation, and then I'll pause, is just the penalty for missing has been way, way harsher than the reward for beating. And so that's why I care. I care that the earnings could be too high for companies that have high input costs, high exposure to input costs on oil derivatives.
Okay, Michael, I'm going to come to you just a second, just to stick with you for a second, Adam Parker. So if market prices are all that matter,
yeah,
market doesn't seem too worried at this point, right? We're back at all-time highs, right? So do you think that is, as best you can tell, the right pricing, or are you concerned that the market isn't pricing in some of these shocks from the oil price shock?
You could say it's complacent. I don't know a lot of institutional investors that are kind of proactively positioning or using a ton of derivatives around it. I think they're just saying, hey, last year I called 46 of the 0 recessions related to tariffs. So I have some scar tissue from getting too economically negative. So, hey, this doesn't really affect the Mag 7 and Broadcom, the grade 8. It doesn't really matter that much to semis. It shouldn't, other than like transportation-wise, affect healthcare or that many financials, utilities, materials. So they go down the market and think, okay, so maybe it hurts 10, 15% of the companies, but I don't want to overreact and get too negative in the interim. And so I think there could be complacency about it, but I also don't think it's going to necessarily hit a ton of earnings until the second half of the year. And meantime, big upper revisions in tech and comm services and energy. So there's enough for the bulls to chew on about their earnings coming up, at least for now.
Okay, and right before I go to Michael here, that potential impact in the second half of the year, is that your expectation? Is that your default suspicion here, or are you sort of like, I'll just wait to see what happens?
Well, no, we're recommending, and obviously the devil's in the details on which specific stocks and industries, but we have sort of broad underweights on both consumer staples and consumer discretionary. One, I just checked all the earnings call transcripts, over 1,000 companies since March 1st on any commentary from the management teams related to Hormuz and oil. And staples and discretionary are a lot more negative than positive comments. So I think it stands to reason that they'll probably have some, higher input costs. And it's not just oil. I think the whole commodity complex is up. So I do think that that you want to be more cautious about estimate achievability for a lot of the consumer companies. And then it'll also be select industrials and transportation and other stuff where they don't have hedges. So it will affect companies, but I'll say it's 15% of the companies, maybe not 75%. And maybe that's where the devil's in the details.
Okay. I think we might have a little bit of a lively discussion here then, because I could be wrong, but Michael Pento, I'm pretty sure that maybe you have a different opinion, at least in terms of the impact of this on the general economy.
Well, yeah, let's look where we're starting from. First of all, the bottom 4 quintiles of consumers have been in a recession since COVID ended. It's only really the top 20% that are keeping the economy going. And if you look at the stock market, it's really concentrated in tech companies, semiconductors, that are doing the best. And like Adam said, just like the consumer staples are lagging pretty sharply here. But even if the war were to end tomorrow, and I don't think it is, because unless you get rid of the IRGC and manage to militarily control the Strait of Hormuz, we're going to have a lot of problems for a long time. But let's just say, hypothetically, the Strait opens up tomorrow. There's going to be a lot of hoarding of energy. And it's not just energy, it's fertilizer, it's sulfur, it's phosphorus. It pervades throughout the entire economy. So I'm looking at inflation, which has been above the Fed's asinine target for 5 years, 2% inflation, which is 3.3%, the last metric that we've seen. It's going to go north of 3.5% probably in April, CPI. And that's the way they hedonically and substitutionally count it. So you're going to have a tremendous amount of pressure on the consumer. Now, does that engender a recession in the immediate future? I don't see any indication of that, surprisingly, because that's how strong the top 20% of consumers are. They still have a lagging wealth effect here, and their incomes are rising in real terms. It's just the bottom 80% that has been crushed and is going to be crushed even further as this inflation bow wave pervades across the globe.
All right, Michael, a couple questions. How much weight do you give to the top 20% of consumers, of households that are doing really well, right? Versus the CapEx spending in the AI space? Which do you think is propping the economy up more here? What's a bigger factor?
They're both. I don't know if you have to weight one more than the other. I think the research I showed that like 40% of GDP is CapEx spending for the hyperscalers. So yes, both are working in tandem, but it's a thin veil. It masks what's really going on underneath the economy, with consumers and with the stock market.
Okay, so one of the questions I have here was sort of odds of recession. Michael, what I hear you saying is I don't think we're going to see one in the near term. Your model, which I'm sure you'll tell us a bit about in a moment, doesn't seem to be blinking that one's here. Adam, I get the sense from you don't really have any worries about a recession this year, provided things don't get worse in Iran from here, of course.
Remind me what recession is again. That's 2 consecutive quarters of negative GDP. Is that what you mean by a recession?
Sure. I think that's the standard definition of it. Yeah.
Yeah. I mean, so the probability that happens for the last 2 quarters this year, given the stock market predicts by 3 to 6 months to GDP, I guess is pretty low.
Yep. Credit spreads, financial conditions.
90-day credit card delinquencies. There's a lot of data points that don't show that's likely. That does not mean the stock market can't pull back 15% in that time frame. I'm not saying that. I think there's a distribution of outcomes that include that. But in terms of like an economic recession, like, I don't know, it's sometime in the second half of 2027. I'm sure some economists will tell us if there was a recession in the second half of 26.
Can I just quickly interject something? And it's important because I feel I'm pretty well off. I'm sure Adam's even more wealthy than I am too. Both of you, maybe both of you, as a matter of fact. But let's just be a little bit cognizant of what's going on with the American consumer here. They are really seriously hurting. Let's not try to downplay that at all. No, there's not a typical NBER definition of a recession, but there is a very serious problem. Look at the University of Michigan consumer sentiment surveys. You think they're the lowest in history because people are making stuff up?
Yeah,
No.
I totally agree with that.
I'm not saying, if I could just finish, Adam, I'm not saying that's indicative of a recession. I'm just saying let's not ignore the recession that is going on with the bottom 4 quintiles, and especially those bottom 2. They are really, really hurting. And I just want to be empathetic to what their experience.
Yeah, I because I just focus on the stocks, I didn't mean to, not acknowledge your statement. It's just, I think what that means for me is like, we track businesses like who has pricing, who doesn't, because I think about growth margins a lot. And your point is like, I would say, quote unquote, big companies. I mean, McDonald's talked about pricing, Pepsi with the Frito-Lay products they had to cut. Procter & Gamble's talked about it, Lulu, Chipotle, like a lot of management teams are saying they're having trouble raising pricing. And those are kind of upper middle class consumers in some of those products. So I totally hear you on that. But if the debate was about like the S&P level, I was just saying, I don't think it matters. If the debate's about if you're talking about as a human being, of course it does. But I was sort of responding more toward Adam's question about like the whole the S&P, kind of level in the second half of the year.
All right. And if we have time, gentlemen.
I agree with you.
Yeah. If we have time, what I'd love to get into a little bit later is what you think the societal impact of all that is, right? Michael just said it's the bottom 4 quintiles, right? And I think that maps, right? Top 20% doing great. These are the folks that own the financial assets that you're tracking, Adam Parker. But, as the bottom 80% gets left further and further behind, does that matter? Will that matter? If so, when will it matter?
I don't have the facts in my fingertip, but I don't believe it's as bifurcated down to the 80th percentile. I don't think it's quite that extreme. But but anyway, keep going.
Okay. Well, I mean, I don't want to get into it right now unless Michael Pento, you really want to. We can have you bring up your data there on the quintiles. But real quick, let me just sort of continue digging into.
Can I just interject real quick?
Yeah.
I think it's like I forget right now. I didn't prepare the exact percentage, but I think it's 50 or 60% of Americans don't have $1,000 in the bank for an emergency situation. I mean, that's pretty dire.
Right. And we're seeing, debt defaults, debt delinquencies at least, and defaults as well, I suppose, beginning to rise dramatically in those lower quintiles.
Right.
But even the prime borrower, we're starting to see some of that as well.
Mm-hmm.
So, all right, we'll get into all that in just a moment here. Let me get back to the Iran part just to try to flesh that out a little bit more. So, I asked you guys, okay, so if everything ends tomorrow, right, what impacts do you think might be rippling towards us in time, right? And kind of what I'm hearing from you guys are, Michael, I'm hearing from you, well, there's definitely going to be an inflationary impulse that's going to hit a lot of commodities, but maybe not as one, strong enough to send us into recession. Adam, I'm hearing from you, markets don't really seem to care much at all right now. What would happen if this really turns into a quagmire, where we're stuck in Iran, the Strait is closed for many more months, perhaps things get kinetic again, maybe Iran starts destroying additional infrastructure in the Gulf. What does that do to your guys' outlook? Adam, let's start with you.
Well, I mean, it's hard to, with that setup, it's hard to say it would be great. I think you probably, right? I mean, there's two things. There's the multiple and then there's the earnings. So I think on the margin that what you described is the stagflationary fear, which is typically bad for multiples. And you also described probably some earnings issues for 15 or 20% of the companies. So I think that in that scenario, you're talking about a pretty big growth scare that could move equities, materially lower. I think the challenge is, if you look at, and again, like now I feel bad. Michael made me feel like I'm a bad human being because
I didn't mean that.
But like, I care about the stocks. Okay, that's my job as a human being.
Yeah.
I do cool stuff, but I don't talk about my political views or my human views on these kind of things. I talk about the stocks, right? That's what I do for a living. And like what the market's telling you is there's an asymmetric skew, right? Like if we get good Hormuz news, the oil prices go down way more than if we get bad news, they go up at this point, right? So when we get good Hormuz news, the stock market goes up way more than it goes down when we get bad news. Like there's currently an asymmetric skew. You can't deny that. So the question is, will something change that? Right? I mean, I think from the trading behavior, will something change that clear positive skew toward, it's an insane sentence I'm about to utter, but the second derivative of Hormuz news. So it has to get like way worse for the skew. Could that change what you're describing? I'd say, yeah, it could. But I think it would, quote unquote, take a real company to come in and tell you it's a problem. Obviously, if ODFL says it's messed up, nobody cares. But if Walmart comes in and misses big, then yeah, the stock market view will change.
Okay. Let me just ask you this gut feel. Let's say talks just break down tomorrow and Epic Fury 2 kicks off and, U.S., Israel start bombing Iran again. Iran starts shooting at other neighbors. What do you think the stock market will do in reaction to that? Obviously, that would be a negative, but how much of one do you think?
NASDAQ's down 3, SP's down 1.5, 2.
Okay. So sort of like we've seen this movie before.
Is that day one, Adam, or is that?
Yeah, I thought he meant T+1. Sorry, you meant like.
Yeah. No. I meant the
3-week prolonged thing, and
yeah, I meant the initial reaction, right?
Yeah, maybe 1.5%, something like that. Yeah.
Okay.
It's been less than that recently, but we'll see. Yeah, but that was the beginning. That's what happened at the beginning on February 27th, right?
All right. So Michael, to this prolonged situation question I just asked Adam, what would your reaction be? Similar, or do you think it would be more material?
Prolonged conflagration in the Middle East? Well, first of all, that would send CPI up even higher, and that would send interest rates up even higher. And bear in mind, a lot of this GDP growth is geared off of capital expenditures, which are more and more done with hundreds of billions of dollars in borrowing as opposed to cash flow.
Mm-hmm.
So interest rates are going to go much higher as they follow inflation higher. That could put the kibosh on all this borrowing. And I think that would send that top 20% into the bunker, because if interest rates spike, and it's a reasonable, rational conclusion, if oil goes to 150 and stays there or thereabouts, you'll see stocks drop and you'll see home prices drop. And that really torpedoes the 20%, top 20% purchasing power. So I think the odds of a recession go much higher if it's protracted and if oil stays above 100 to 120 for any kind of duration, a couple of months. It would be a big problem for the stock market, in my opinion. The first day, who knows? See, what happens the first day, Adams, who knows? I mean, you can get a tweet from Trump telling you, everybody, that, hey, things are going great now, and we're about to sign a deal. And then the next thing you know, you turn around and you go to the bathroom, you come back and bombs are being lobbed at ships. It's that stochastic.
There's a big difference between like what we're talking about as human beings and like you want to start shorting stocks because of it. I just point that out. Like you want to walk in the office today and you want to start shorting Micron, go ahead. Like, what I'm saying? Like, so I think it depends on what we're talking about. I agree. Well, I think we said the same thing. I think, Mike, when I agree, like if you get a real stagflationary environment, it's going to be bad for equities and bad for multiples. I think that's for sure. But I mean, what the market's telling you is like the world's awash in oil and natural gas. And on the other side of this, whenever it is 12, 24 months from now, it'll probably start slowly coming down. I don't think the average consumer gives a crap about the Fed. If I tell you, like the person you're talking about, the average American, what they care about is we went from $2.79 to $4.50 national gasoline average unleaded, and that's a bigger issue for them than whether the Fed cuts another 25 bips or not. So, all
right. So let me ask you this.
That matters a lot as a human being. Yeah.
So let me ask you this, Adam. Now flipping back to the optimistic side again. So let's say this thing ends soon. What do you expect oil to do in response? A swift decline, or is it going to take a while before we get oil back to any place that's really making gas prices comfortable for the average American?
I mean, I would say I'm just quoting other people that I rely on who are expert, not my own independent opinion. But I think the consensus view is it takes much longer to normalize than what's in the 12-month forward Brent, which I think is, last I checked, high 70s. Somebody can quote me on that. Yeah, check that out. But the 12-month forward number is probably not likely to be right, to be revised higher. So my understanding is, even if we've already really truly reach some agreement now, that it would take several months to get back toward where we were already, maybe a year. So
Okay.
I think there's damage done already to consumer discretionary and staples earnings. The only question that's more of a debate is like, will the multiple expand just because people say, yeah, but I know eventually it'll be better, right? The market's more anticipatory than the fundamentals.
Okay, and so obviously that's got to be a factor why you're not super bullish on discretionary consumer right now or staples, because that's going to be,
Yeah,
they're
I
going
think
to
the
spend
earnings
less
are
money
I
to.
think estimate achievability is below average, and I think that's all that matters. Is you want to buy stocks where the estimates are too low and sell the ones where the estimates are too high.
Okay, so
And
then
that's a
let
big
me
reason. Yeah.
let me ask you about the oil and gas sector then. So if you think that prices are going to remain elevated for a good while, maybe more than the conventional Wall Street forecast is right now, does that make you bullish on that sector?
We were overweight both energy and materials till like 3 weeks ago, and then I downgraded them to neutral under a thesis that I didn't like how they were acting, the opposite of what we were just saying, right? Where we got, good news as human beings that we might be done with this thing, and oil would go down way more than when we got bad news, it went up. So I think everyone knows the estimates are pretty achievable. The upper revisions have been pretty strong this year. I think there's like a 0.8 correlation between the change in the oil price and the change in the net income of the energy sector.
Mm-hmm.
So like people know the estimates are coming up, but I think the challenge is just, do you just get multiple contraction that offsets it? So I mean, look, also a lot of my clients, institutional side, are trying to beat the SP 500 long only, and energy, I don't have the exact number. I'll say 4.5% of the S&P. So like, can you own 5 or 6% and be kind of close to market weight? Yeah, that's what I think a lot of guys are doing, because they're just worried about getting much more overweight in case we get, a market reaction that's sharper than the fundamentals. I'm going to lean over and quote, the sun's drilling me.
Sure. As you do that, Michael, I'll give you a chance to add on to anything that Adam just said there. Let me also ask you this question, though, just to include in your response. The statistic I've heard thrown out there is that 20% of the world's oil and gas transited through the Persian Gulf before it was closed. Do you think that if the war ends and the Gulf reopens, will we go back to that same level? Or do you think that the percentage of world energy that's going to be purchased through the Gulf is going to be permanently lower going forward, because countries are changing their behavior and saying, look, I underestimated the political risk of the Gulf. I was happy to buy it when it was cheap and everything was fine, but now I gotta take political risk into account, and I'm going to shift. I'm still buy from there, but I'm going to shift more of my buying to quote unquote more politically stable sources.
The latter there. I mean, I think because of hoarding and just insurance costs that have to be passed along to the consumers for these ships passing through the strait, oil is going to be higher than $65 a barrel for a very long time. But I think we're getting too overly myopically focused on the Strait of Hormuz and what's going on. I understand why we're asking. This is the salient in minds of most investors right now, I think. But we have so many other things that we have to talk about. And one of the things I want to make sure I get to is I love Adam's response to it. Is does he see any changes in the flows of capital going into the stock market as going out in the 2020s, later 2020s, and going forward, as opposed to what happened from the 60s to say 2000? Because I see some trenchant, dramatic changes in the flows. I would love to hear what he has to say about that. Much more important, much more long lasting, and impactful than what's going on in the Middle East right now.
Yeah, I love that topic.
Hey, Adam, why don't I jump in just here for a quick second, as someone who's interviewed Michael a lot. Michael has a framework for how he looks at the future. Michael, if I'm quoting you correctly, it's a triumvirate of bubbles that you are concerned about here that I think play into the topic you're raising here. Bubble in the stock market, bubble in the credit markets, bubble in real estate. Am I capturing that correctly? And if so, to give Adam a fair chance to really respond to what you're talking about, maybe you might want to walk through some of the slides that you prepared so he has a good grounding in what you're talking about.
And I'm going to get to that. I just want to just give me a few seconds here. I won't take much time. I'll try to go as fast as possible.
If you want to set it up, feel free. I can tap dance or you can talk to Adam, whichever you prefer.
You just smile and just let all the ladies look at you. And that's
Michael's a silver-tongued charmer, Adam Parker, if you haven't learned that already.
So I look at debt levels. We are becoming a debt disabled country. And debt-disabled countries tend to grow more slowly. I look at demographics. So, for example, we had 2% population growth ex-World War II, and now we're down to 0.5%. We had a very big increase in the labor force participation rate from the 1960s, 70s, 80s, 90s, 2000, when women were entering the workforce. Now that is aging out. So we're seeing the labor force participation rate go from 60 to 66. Now it's down to 62. So that's a headwind. And then I think we have decades, years, if not decades, of rising interest rates and rising inflation. And even more, maybe not even more important, but as important, we have a new Fed chair coming in who was going to replace the biggest money printer in U.S. history, Jerome Powell. And this individual wants to shrink the Fed's balance sheet. If you shrink the Fed's balance sheet, it's going to be diametrically opposed to what's been happening since 2007, 2008. So if you have a shrinking Fed's balance sheet, you have debt, you've got demographics, and you've got rising interest rates, there could be huge problems that sit on top of the triumvirate of bubbles that I'm going to show you. And Adam, and I apologize, Mr. Parker, I'm going to try to go through these as fast as possible. It's not a big thing.
Thank you. This is awesome.
Here's the Fed's balance sheet. You could see from 2007, it was about $800 billion. It peaked at $9 trillion. You imagine in the United States of America? Adam mentioned something about people don't care about the Fed. And I agree with him. But my God, if they knew that they expanded base money supply from below $1 trillion to $9 trillion, that to me is completely pathetic. And few people are cognizant of this, but look at this QE that's been going on. Or you see this since the end of 2025. The Fed printed $170 billion because of the war, I believe, or just to go out with a bang. I don't know what Mr. Powell was thinking, but I think this is absolutely disgraceful that the Federal Reserve would be printing all this base money supply, high-powered money, as it's called. And of course, this is indicative of, look at this this is the real Fed funds rate since the year 2000. Every time, since we're such a financialized economy with so much debt, every time the Fed tried to raise interest rates, we've had a recession. So here's a 2.5% real Fed funds rate, boom, right back to where it was, negative. And it's riding along here for like 14 years. Look at this post-COVID, minus 8% real Fed funds rate. That's pitiful. Never before happened in history. And here we are back up here trying to pretend like we're a real economy again and a strong currency for our middle class and our consumers. And we're right back down to 0.5%. So we're having 0 to negative real funds rate, which engenders all these bubbles. Look at the reserves for banks. You wonder why, look, we have such a great banking, what strong financials we have. Look at this money that they've created. These are reserves for financial institutions. Look at the boom in M2 money supply. I would love for people to hear about this. Let's just talk about the debt bubble. Leveraged loan market was $800 billion in 2007. Now it's over $2 trillion. Private credit market has grown from $100 billion in 2007 to $3.5 trillion globally. And it's on pace for $5 trillion in 2029. Here's some debt metrics that I think people should understand. Total business debt is 70% of GDP, same as it was in the 2007 global financial crisis. In 2007, we had just 10.4 trillion. Today, it's 22 trillion. Add to that the national debt, which was at 30% of GDP in 1980. It's 123% today. Now, if you want to look at total U.S. non-financial debt, total debt, public, private, everything, has soared to 77.9 trillion or 256% of GDP. It was 19.3 trillion or 189% of GDP in the NASDAQ bubble of 2000 and 33.7 and 234% of GDP at the start of the global financial crisis. Stock ownership. Let's talk about the stock bubble for a moment here, if you don't mind. Stock ownership is at a record high. That's the percent of household assets that are invested chasing this bubble higher. This is the margin debt relative to GDP, also off the charts. This is Wilshire 5000 GDP to GDP. Okay, this is the ratio. Look at where we are. Even it dwarfs where we were in any other period of history. Total value of public and private companies to GDP. This is all thanks to the money printer that sits at the Eccles building, who's, thank God he's on his way out. We have a very concentrated stock market as well. I'm almost done, Adam. Here's some valuation metrics that everybody should understand. Total market cap to GDP, I just showed 227%, highest on record. The average is 90%. So the value of all companies relative to GDP should be around 90%. It's 227%. Price to sales is 3.5. It's the highest in history versus the historical mean of 1.8. The Shiller Cape ratio, cyclically adjusted PE ratio, 41, second highest in history, just below 42, which was in March of 2000. We all know what happened then. We have the lowest dividend yield in the past 50 years. And one more data point, equity risk premium is negative. So the earnings yield is 3.2%, T-bills are 3.6%, meaning equity risk premium is near the lowest, is negative and near the lowest in history. Yeah, I lied. One final chart here. Here's the bubble in real estate. Look at the home price to income ratio. This is courtesy of longtermtrends.net. Higher than the housing bubble. And you know what? The real estate is also not just the home price to income ratio. When you add in taxes and insurance and HOA fees, believe me, I know, living in Naples, what those are like. It's the most unaffordable housing market in history. So these are the triumvirate of bubbles. I didn't make it up. I don't want it to be true. Those are all facts. They're irrefutable facts. And we have the most expensive stock market and real estate market in history, and we have a gigantic debt bubble, and they have to be reconciled. And they usually reconcile with both the numerator and denominator falling. So that's my 2 cents. Sorry if I went on too long, guys.
So Adam, I'm going to let you respond to that. I'm quite familiar with this framework and argument because I've interviewed Michael quite frequently, but very curious. And you're a stock guy, so I'm suspecting some of your answer might be, I'll care about it when the market starts caring about it. But I think Michael raises a lot of really good sort of just secular points.
Yeah, there's
What's your reaction to them?
Well, no, I appreciate the perspective. I mean, trying to keep the human element in mind since he started off that way. What I would say is I go on TV a lot, right? And if somebody says to me, are you at all worried about U.S. government debt? I feel like a jerk if I say no. I think the better question, though, is should I position an equity portfolio today for the inevitability that's going to matter in the next 6 to 9 months? So nothing you said actually affects that second question, because you could have said every one of those things that are all really big issues every year for the last 15 years. So that's my initial reaction. I'm going to talk a little bit more because I think what you're right. I think you gave factual things. Most of the facts you gave about the equity market are correlated to each other. So in some ways you just gave one fact with 7 different data points that are the same fact, but I'll get to that. And that's not an insult. It's still a problem. And I'm not refuting that. My real answer is I think a lot of the concerns you have, like equity risk premium, have zero predictive value for the equity market in timeframes less than 3 years, have some modest in 3 to 5, and have some success, but not a ton in years 5 through 10. I sat next to a guy named Marty Leibowitz when I was at Morgan Stanley. Marty is the most published person in the history of financial journals, basically invented bond yield math when he was Bloomberg's boss at Solomon in the 60s. He's just a wonderful human being. And he wrote a book on this topic that I was lucky enough to collaborate with him on and update. And we kind of showed that equity risk premium does not have predictive value in time frame. So I think the problem is every equity investor might be worried about these issues, but they just don't think they need to position for them now. And so the number one signal that tells them they need to is going to be negative momentum. which I know seems tautological, but that's just the fact. So I don't dismiss anything Michael said. The only, in terms of the facts, the only thing that I think we could debate further would be your comment about expensive equity market. And the reason I would push on that is I know Cape and Schiller PE and Grantham don't have any predictive value, and I would have probably ruined my career if I listened to any of them in the last 10 years. Because all they're really saying is the same thing, which is that gross margins are going to get killed for the average U.S. equity or for the sort of bolus of gross profit dollars. And the reason the market looks expensive in EV to sales is because the market has the most market cap it's ever had with above 60% gross margin ever. So you just have a different constitution you had in the 70s or 80s when 8 of the 10 biggest 10 equities were energy or more capital intensive. So I think there's some rationale why it should trade at higher multiples in the future in the past. But again, that doesn't refute anything that you said at all. I think the only pushback or the only thing I struggle with is how to time when to get bearish based on things that have been sort of an obvious problem for a long time. The one last comment I'll make is I 100% agree with you on the balance sheet of the Fed, not from your criticism of the Fed, because I don't feel like I'm qualified, but more that I've studied the week over week change in the Fed balance sheet, which comes out every Wednesday, versus the week over week change in the equity market. And that's highly statistically significantly correlated. So when they've expanded the balance sheet, for sure, it's made the equity market go up. That I'm 100% on board with.
Adam, Taggart, can I interject?
Sorry, too long of a reaction.
No, that was perfect. You might be surprised to hear my answer, Adam Taggart and Adam Parker, is I actually agree with everything he just said. What I just mentioned there, that presentation has zero to do with timing. I agree. I have an inflation, deflation, and economic cycle model that looks at the second derivative of inflation and growth to tell me when to get nervous. That presentation has everything to do with to tell me when we have a recession or when we have, and not, I didn't use the word if, when we have a recession and when we have a credit crisis, how far can asset prices crash? That is the total purpose of creating the PowerPoint today, not timing. And I might be surprised, Mr. Parker, that I am not short the market at all. I'm actually net long.
Yeah, I had a feeling you were going to say that. Yeah.
I have a lot of T-bills admittedly I have a lot of T-bills in the portfolio because of the
Michael, you know why I get pissy about economists? Is because when I worked at Morgan Stanley, they called for interest rates to rise every single year I worked there, and every single year they went down. And so I have serious PTSD on that topic. They always lead with this view that tons of supply is coming online and it won't be met by demand, and so bond yields are backing up. And then what happened is when people got afraid, they bought the 10-year yield and it went lower anyway. So if I impregnate their backup in yields into my equity view, I make a bad call. So it's a little bit of that was behind my initial, diatribe. But I agree with you. Look, our math is about 65% of the S&P 500 is an AI semiconductor ETF. So when I do my meetings, I did a couple of meetings today in person. All I'm trying to figure out is, who's over-earning the most to the least in the AI exposed part, and then what's actually fundamentally doing well that isn't correlated to that. Because we do a lot of risk management work. We have a ton of clients institutional clients that send us their books to do custom risk work, and we're just trying to help them figure out how to diversify. I think if we all know when the data center overbuild becomes obvious, we want to be out of equities 9 months before that, and that'll probably supersede everything you said or exacerbate everything you said.
Mm-hmm.
So, Michael, just for the record, I wasn't surprised at all that you had a lot of commonality there. I'm very familiar with the second derivative primacy of your model there.
Yeah.
All right, gentlemen, I want to get to where you see opportunity in this market. Just a second, real quick. Let me just toss in here. How much are you worried, if at all, about the headlines that we've been seeing in private equity? And how much does that factor, if at all, in terms of your current market outlook? Adam, why don't we start with you?
Let's let Michael go first. Can we let him go first? I feel like I want him to get lathered up.
I think that's the nucleus of the credit.
But you said private equity, not credit, correct?
Did I say equity? I meant private credit.
I personally, and this is just my opinion, the major funder of the PC market is private equity, 80% or so. So I don't disaggregate the two. So that's the nucleus of the bubble. It's where the riskiest loans are. They're illiquid, highly leveraged. So I see that spike in default and delinquencies. I see the gates going up. It's just a prelude to what's going to happen to the overall credit market. And I think a perfect catalyst, like Mr. Parker and I were talking about, neither one of us are short the market. That's not how we invest. Just because the stock market's expensive, that's a terrible timing tool. You'll be looking for a new career if that's what you're going to do.
Right.
But if you're monitoring, my model looks, assiduously as credit markets and financial conditions, and that tells me when I need to, reduce longs and start to increase shorts. And I'm myopically focused on the PC and PE markets because that's where I think the trouble lies. That's in the vanguard of the breakup of the credit bubble.
Yeah, I mean, one of the things I feel like I've learned through the years is that any product you're not willing to invest in yourself, you probably shouldn't love that much the companies that do it. Like a couple of years ago, my financial advisor presented me with a private credit opportunity. I think it was like a 13% unlevered interest rate. And so he knows me pretty well. So he knows there's going to be some incoming feedback to the product suggestion. And I was like, who the heck is lending to me at these rates? Like how many nail salons in Naples, Florida, or just saying that because he lives, how could that be like that I would get 13%, right? So there's no question that when I meet the CIOs of these big wealth networks, their clients seem to want more privates. They want more alts, right? But in the products themselves, a lot of them are bad products. They're and I agree with you. When I saw, I would say not just, some of the stuff last fall and one or two owl funds, but I saw Blackstone, BlackRock, and Morgan Stanley put gates on. Like these are the most real companies. This isn't so. I agree, it's a problem, and I personally would not put any of my individual dollars in any of these things. But I view that. I kind of think that about private equity too. I think they're both really not user-friendly products, and I would recommend anyone who's trying to allocate themselves to have a very small amount in those sort of things.
Let me ask you this question that I've asked Michael in previous discussions, Adam. Personally, I have a hard time looking at this move to give the retail investor access to private equity. It's hard for me to look at that as anything other than the private equity investors saying, okay, how can we dump our worst performing, dog investments on an unsuspecting public? It just seems like it provides them with some exit liquidity for their least favored assets. Do you look at that similarly, or do you have a different opinion?
That's probably more negative than I would look at it. I think it's just more that they can't fund new investments because they're tied up in some poor previous performers. So they need to access more kind of initial investments to fund future growth. I mean, I dig your cynicism. Don't get me wrong.
I think sorry to interrupt, but just if that were the case, wouldn't just human nature be sort of, well, if we want to raise some new capital and need to sell off some of our assets, well, let's sell off the ones we don't want the most.
If they can. I mean, the challenge is like a lot of them, they can't. So it's not even like they're underwater and they don't want to market or whatever the issue. They're hoping for things to recover. Like it's not all just, they don't even know how bad some of them are yet. So there's some kernels to what you're saying that I agree with, but like I'm not even that negative on. I don't think people are trying to mislead as much. It's just they want more inflows. Like here's why the product's terrible. Okay, I mean the average product. Okay, one, they charge you fees when they don't even call the capital. Okay, imagine that I tell you I'm going to give you a dollar, and you don't even call 85 cents of it for the next 5 years, but I pay you $2.20 the entire time on the dollar.
Yeah,
so that's one problem I have. Two, I have no idea. It's a very non-user friendly product. I can't figure out my 17 passwords. Then you call capital, then you return capital, even though you haven't called it all. And at the end, you make up these metrics that no one, I don't want to sound like I'm an accounting expert or whatever, but I think in like a court of law, I would probably be considered an expert. Okay. I mean, I'm pretty confident I would be. And like, I don't even know what the hell my guy's talking about. He's using MOAC. I don't even know what the numerator or the denominator is. Okay. All I know is that what's in my checking account at the end is completely unrelated to what was there in the beginning relative to what he told me my IRR was. So I think it's a shit product for most people. And I wouldn't recommend your average individual, retail investor start piling in because they know somebody who worked at KKR and got rich there. Right? I just think that whatever their math is, they got to be careful. And I'm not saying KKR won't be a good stock from here, maybe in a 2 or 3 review. Woo! I'm not making that individual stock comment. I'm just saying people got enamored because there was massive wealth made in the 80s and 90s because of a one-way interest rate environment and some other, kind of tax advantage situations and other stuff. But that is not what the individual person is going to experience from here in mass market.
Okay. I don't want to spend a ton more time on this topic, but Michael, anything to add?
I don't know. If Michael loves it, now I feel bad.
No, I know that Michael doesn't love this.
There's no way he loves it based on his setup.
I'm not a big fan of Wall Street to begin with, but I mean, here's Wall Street. One thing Wall Street did that was very good, in my opinion, is they managed to make investments very liquid and transparent. So, but leave it to Wall Street to say, I can reverse engineer this whole thing. I can make a loan to a highly leveraged corporation. It's illiquid, it's opaque, and we'll market to model. Oh yeah, give me some of that.
Right. And I'll charge you fees on it.
I'll charge you fees on it. Yeah. So
I won't pay taxes on the carry.
And I can put up gates and walls and tell you can't have your money.
I'm pretty conservative on a lot of financial topics, but it's hard for you to explain to me, like if you're a regular W-2 employee for a lot of your life, like you worked at Morgan Stanley, explain to me the math on the carry. Explain to me why that's cool.
Mm-hmm.
All right, keep going. Now we're human, Mike. Oh, you like I got pretty human there.
Adam, Mike, I guess I have to apologize to Adam. You are very human. My point is, I just want to make sure that people understand that the differences between the economy in aggregate and consumers in aggregate, and then
totally why I said the economy and the stock market are unrelated, because like the economy affects your everyday person, but the stock market has nothing to do with that. That's kind of I said it differently, but I agree. Yeah.
Well, to that point, Adam, and I appreciate you keep bringing it back to the human element. I actually want to try to bring out the Vulcan in you, the guy that says, all right, forget about all that. I just want to make money. Right. So as you look ahead to the rest of 2026, where do you see the biggest opportunity right now for investors?
It's funny. I find myself more in like blow up avoidance mode than bullish on some things. I guess I'll tell you what my calls have been, and we can criticize them. Sure. But one has been, and I'm a former fundamental semiconductor analyst. Okay. So we've had this view that our North Star, we wrote a note 2 years ago plus, is to own semis over software. Lately, after the huge rally in semis, I find myself more negative on software than sort of saying buy a bunch of Micron today. But I think it's one of those challenges of like, you put a gun to my head.
Sorry, you said software. Did you mean you're now more negative on semis than you were?
No, I'm more negative on software than
you're even more negative
positive on semis. Okay. It's sort of, and I can walk through the details of that if you're interested. But the call that we've had that's been the most wrong, how about that, is I like healthcare. It's not because it's cheap. It's because I think the whole point of all of this is that people live longer and they're more productive while they're alive. Mm-hmm. And there's so many businesses there that have lots of employees, lots of revenue, low margin. And if they get better at predicting their employee and customer behavior, are going to have margin expansion. So I like these things like Quest and LabCorp and McKesson and Cardinal and Cora. And I like some of the managed care and hospital businesses. And I like tools and diagnostics. We have a lot of old people that demand these things. And so revenue per share for the S&P 500 healthcare has grown every year, 30 years in a row, including financial crisis, COVID, whatever. They have a lot of, I think, AI productivity beneficiary potential. Right now, only 16% of S&P 500 companies are even saying they're doing cost-related AI stuff. So it's all on the come. The sector has really low correlation to AI semis. There's tons of deals. Like, I like it, but the aggregate, some of those stocks have been decent, some haven't, but like the aggregate call looks like it's been bad. And so, I'm worried I'm tethered to the thesis, but I'm very bullish on, I guess I'll stop by saying the market's telling me there's 0% chance healthcare is the best performing sector in the next 5 years. And I think it's 30 or 40%. And so I'm just I'm interested in that differential.
Okay.
It's one of the, and Adam's, just to underwrite what he said, it's one of the few areas that are making, producing a lot of jobs regularly.
Yeah, and at least until the robots come along, that probably still will continue to be the case. All right, so Adam, I heard you say, you were sort of talking about your past calls, but if I got you right, you said, I liked semis over software. I don't know if I heard you say you like semis even more, but I heard you like software even less.
Yeah, right I still like semis over software. I just feel like sometimes you feel like there's things you're saying where you're seeing the ball clearly and sometimes you're not. And I feel like I don't want to be one of those guys. There's nothing grosser than someone who victory laps when they weren't even right in the first place. So I wanted to acknowledge the healthcare call has been a bad call. I really like the thesis. Okay. and I'm trying to figure out, could anything change my mind? And I don't want to be intellectually dishonest and all that. But the call we've had, I think a good call on, is to be negative on software. And the reason I think I'm seeing the ball clearly there is whenever you see multiple contraction, like you've seen there where the stocks are bad, I think what happens is pretty clear. One is the first phase is multiple contraction. The second is they start missing on earnings. And that really resonates with me because there's two ways they're going to miss on earnings. One of the challenges with all the big software companies, and I'm talking the loved ones, Intuit now, Salesforce, whatever, Adobe, Workday, whatever, is the sell side analysts don't have the gross margins or the net margins going lower ever in their models for the next 5 years. They assume 80% gross for every company. So I think the problem is they're going to have to spend money, both OpEx and CapEx, to attach all the AI tools that are going to enable them to keep customers. So I think the average company is going to miss on that because they're going to have more costs. Moreover, the CTOs, the chief technology officers, the big financial institutions and others are going to be able to push back on pricing. And so they're going to miss in quarters 1 through 6 or 7 or 8 on earnings. Then the second phase is 3, 4, 5 years from now, they're going to miss on sales. And so what the market's telling you on average is correct, that the distribution of outcomes for the average software company in 2030 is skewed to the negative. And I think that means the median software company will underperform by another 30 to 50% over the next few years. There could be individual names that are great, but the ones that are going to be good are not cheap ones and are not slow growing ones. The ones that are going to be good are expensive ones because the market average is already right, that it's sussed out, security and other stuff that probably are never going to get stripped out. If I worked at Morgan Stanley and I said, hey, I cloud coded some awesome security, and then Ted Pick listened to me, we'd both be fired if there was a security breach for being idiots. So you might just pay Palo Alto forever or CrowdStrike, whatever, just because you want to just say you have the best, even if you think
you've got the best brand.
Yeah. So there will be some that work, and I'm not saying all of them are terrible, but I think the median one's in trouble, and I think the market's telling you that pretty clearly.
Okay, and is that pessimism about the sector in general largely due to the AI threat?
Yeah, I think it's what I described. I mean, it's just, you're going to have to spend money to attach. It's less pricing and the amount, like one of the guys who works for me coded 30,000 lines using 2 agents in the last 2 days. It would have taken him 6 months and it took him 2 days. So like just the ability to produce things that are value add are going up. And so the grip that these companies are going to have is going to slow over the next few years. I think the problem is the way the analysts do work, and I'm sure Mike will agree with this. What do? You're a sell-side analyst. You call the CTO of a few companies, your channel checks, and you say, hey, you're going to get rid of ServiceNow. And they say, hell no, we could never get rid of them. Then you call the IR guy, and you guys crying your beer together, and you say it's an overreaction by idiot retail investors or whatever you want to blame it on. The reality is they're going to miss earnings in 2030 by a lot, and you don't know that.
Okay. 2 more quick questions for you. Then Michael, I'm coming to you. And Michael, specifically, I'm going to come to you and ask you if you wouldn't mind sharing how your portfolio is currently allocated, given what phase the market thinks we're in right now. But real quick, Adam, staying with you. So, okay, sounds like you're saying, look, I still like semis. I like software even less than I used to. Damn it, I think there's still opportunity in healthcare, and I don't care what you say. I'm going to still be long there. Any other places right now where you're just saying, okay, this is what's going to be a hot part of the market for the rest of the year?
I mean, our official overweights are healthcare and tech, and our official underweights are consumer discretionary and consumer staples. Obviously in individual sector, there's always tons of, subplots that are interesting, but
Sure.
I think the main challenge is that when you manage a fund, say long only versus the S&P, that sector-based management doesn't make any sense, because the way a lot of money is run is, there's an analyst in every sector. So the industrial guy says, oh, well, what's going fast? I'd like construction around the data center, so I'll own CAT, and I like Eaton for electrification. And then the utility guy says, well, I like GE Vernova and Vistra, and I like Constellation. And then the financial guy says, well, I want to own some stuff that's funding the data center. And the semis guy wants NVIDIA or whatever. And it turns out that all those stocks are 0.85 correlated to each other. So there's like a thematic bet that makes is so dramatic. So I think you've got to find stuff where the fundamentals are decent and it's not exactly correlated to that same trade. And so there's some individual names. We provide for our clients all these screens of like 0.2 or lower correlation to the AI semis basket, up 10% or more in the last 6 months. There's some energy, there's some defense, there's some healthcare, select healthcare and other stuff. But it's got to be. It's just the main challenge is risk managing around the AI trade.
Got it. Okay. And I'm just going to ask you this question because it got asked by users, and I just promised them I'd ask it. Best gut feel at the end of the year Do you think the stock market is materially higher, kind of around where it is right now, or materially lower?
That's me or Michael? Michael.
That's you. That's you, Adam Parker.
Yeah, I mean,
just given what you know right now.
I don't really think that I know I don't have any skill in forecasting the S&P in like a really short horizon. And I also know that nobody else does. And I can explain to you the research on that we've done that's extremely comprehensive. And I think it's a terrible idea to try to make one month market calls and or short-term market calls. And I can prove that. I think it will destroy value over most people's lives. And I'm happy to talk about that more. But because I have a PhD in statistics and I look at data, I'll just take higher. Because about 65 or 70% of 6 month periods, the market goes up. And so I'll just always say higher every time I'm asked that for the rest of my life. And I'll probably be more right than wrong. But like, so that's not an
answer based on statistics, not necessarily anything that's going on right now.
But I'll try. But I should have started by saying everything I'm saying could be wrong. I know enough to know that. Okay. But I'll answer the tenor of your question. The bottom-up sell-side estimates are for a little more than 20% earnings this year and 15% next year. Even if they're way too high, the market, the growth itself, even if it's fueled by Micron and NVIDIA and a concentrated set of names, might be strong enough that even with multiple contraction, the market could be up another 5, 10, 15%. And timing that's going to be super challenging. So I think it's biased toward higher, but that's that, and what do they say? 250 gets you a ride downtown.
Sure. Is it fair to say that unless we start seeing some weakness in those few power horses that are pulling everything along, it's going to be hard for the market to underperform?
I mean, I don't see how the S&P is awesome and NVIDIA is terrible. I don't see how that's possible. One of the if I did a TV show with you guys every night where we watched financial news all day and then said, here's the 10 biggest pieces of BS you heard, like we myth-bustered all day. One of the things that I would probably point to is breadth having any predictive value at the market level. And I would just say, look at the last 3 years. Like the market was awesome in 23, 24, and 25. If you owned a low-fee index fund, you got a lot wealthier doing that. And there wasn't a ton of breadth. The two periods where the market sold off, Q1 of 25 on tariff fears, and the first 2 or 3 months of this year, the grade 8, if you keep broadcasting, they're underperformed. So the market was bad when there was breadth, and it was awesome when there wasn't. So even like the recent data points contradict that. Another thing I'd say is breadth is a weird word. Like all that you mean is the market's really concentrated. Like Michael said, 37 or 38% of the S&P is 8 stocks, Broadcom plus the Mag 7. So it's extremely concentrated. So, but I didn't check today, so this is roughly, guess the best performing stock of the grade 8 this year. Guess how many S&P 500 stocks are better than that? I'll tell you, when I check, this could be plus or minus. The 89th best performing stock in the S&P this year is the best performing of the grade 8. So everyone wants to say it's concentrated, and I'm like, screw you. There's 88 stocks that have been better than any of these things. All you're saying is that there's 8 massive companies. That's true. But there's still 88 stocks that were better than the single best one of those. I think it's Google when I checked or whatever. So like the point is, it's a good stock selection environment. And that's a lot of what I do for a living is like, can I focus people on where they can generate alpha? Where's company specific risk high? Like all the quant stuff that we do. So it's some of this stuff I'm like, I feel a lot more confident adding value there than I'm making a 6-month market call.
Okay, great. And totally understood. All right. So Michael, we're going to come to you for this answer. And then after yours, I'm going to take, if I can, 1 or 2 questions from the audience, then we'll wrap things up and get out of here.
Awesome.
Michael, as I know you, correct me if this is wrong, but the way in which you allocate client capital doesn't have a lot to do when you're actually making the trade calls with what Michael Pento himself feels emotionally when he wakes up in the morning.
Thank God
you
for
are
that.
trading based upon what your model is telling you to do. So what is your model telling you right now?
So I'm positioned for a mild stagflation right now, even though viscerally I'm just scared out of my mind. As a matter of fact, just to touch on what Adam was talking about, maybe I'm just wired to be a Cassandra. I don't know, but what's happening today in the investment in AI reminds me a lot of 1929 and the 2000 internet bubble. Not that in 1929, the radio and autos and.
How old are you? I'm just kidding.
I look good for 100, right?
Yeah, exactly. 140. You look awesome.
So I mean, there's a lot of productivity associated with the internet, with the radio, with TV, with electric appliances, with the AI, but there's also Wall Street tends to bastardize these things and over investment and over leverage, and that's what I'm afraid of. It's one of the things I'm worried about longer term. But having said that, and as I said, I look at the second derivative of inflation, which is accelerating, and growth, which is sort of flatlining here. I'm not short at all. I have aerospace and defense. I'm long energy. That's fossil fuels. Also uranium, clean energy, agriculture, precious metals. Emerging markets have a little bit, about 3%, and a lot of T-bills. That's how I'm, and no shorts at all in the portfolio. If I had any shorts right now, it would be short the long bond. I think we have a lot of bad inflation prints coming up, and that could be extended, protracted, and intensifying, unless this war gets satisfied pretty quickly. That's how I'm positioned right now.
All right, Adam, any reaction to that before we move on?
I mean, obviously, all these things are very specific to whoever's money you're managing, right? And if somebody's, if your client is Mr. and Mrs. Richbags and they own $400 million at Microsoft and they're spewing off a tiny bit for tax reasons every year and you're diversifying away from it, it's a totally different problem than if somebody's got a few $1 million and you're trying to make it it's very specific question. But I think a chunk of assets that I would recommend is an extremely low fee, long only S&P 500 product, which I think likely performs high singles to 10% per year over a 10 or 15 an S&P allocation. But I don't think I have a lot of skill at making short-term market calls. So if somebody gave me a ton of money today, I would dollar cost average it into the equity business over the next 3 months, 1/3, 1/3, 1/3. I've done a lot of research on that, and that's the best risk-adjusted way to put the new business to work. So it depends exactly on the question you're asking. You know what I mean? Yeah.
Yeah, and 90% of money managers don't beat the S&P 500. I mean, but do you benchmark to the S&P 500? I mean, who would put 100% of their money at 70 years old into stocks?
They shouldn't.
That's just imprudent.
Totally.
So the question is, where a long short strategist like myself is, hey, we've had many corrections, 30, 50, 80%. Totally. You have to identify those, protect and profit from those, as well as ride these bubbles higher. If you can do both, then you can generate alpha.
And again, I totally agree with everything you said. And I think it just also depends on how rich you are, right? And what your other assets are. I know people who are incredibly wealthy. And so they might say, yeah, I really care about capital preservation and and I want to live off the interest. There's a whole range, so I totally agree with what he said. It just depends on when I worked at Morgan Stanley, the average advisor was in their early 60s and the average client was mid to late 60s. So it was a very yield sensitive, kind of income sensitive cohort. Right. But, other people the younger generation is more into financial nihilism. They want to have 100% of their assets in crypto or something, or, they don't care about diversification the same way.
Can I just say one thing before you, Adam, I know you're going to toss it to a couple of questions real quick. It wouldn't surprise me if by the end of the year, we saw, everybody gets tired of chasing their tail to get into the next semiconductor stock and the next AI play, and they sell those and go into energy, because that seems to be a very overlooked sector right now, especially what's going on with the price of energy. So that if I had to make a prediction, and again, like Adam says, and I agree, my model says what's happening today in the immediate future. Anybody who tells you what's going to happen later in the year, well, what happens if what happens if Kevin Warsh shrinks the balance sheet by $1 trillion? I mean, who knows? Well, I don't know what this guy's going to do. But if he does, then everybody who predicted a higher closing.
If he does that, Trump will tweet that he's an idiot. Yeah.
Well, I that would be the kindest thing he would do. Yeah. But he does, and to his credit, Kevin Warsh is pro Main Street and anti Wall Street. He will lower interest rates on the margin.
He'll probably buy mortgage-backed securities, and you'll have to buy home builders.
Yeah, Jerome Powell was buying mortgage-backed securities in the spring of 2022.
Oh, I know.
Absolutely horrific job that he's done. I actually agree with Donald Trump I actually agree with Trump to get rid of Powell as fast as possible. The fact that he wants to stay on as a governor is abysmal to me. But I actually have the opposite opinion of Powell than Trump has. Trump is mad because he didn't destroy the value of the dollar fast enough. He wants rates slashed. And I don't think he's going to be able to cut rates, given that it's a committee that sets rates, not just the Fed chair.
I don't think the market's going to go up if they cut rates.
Well, because the long end of the bond market is not going to like it, right? Is that what your rationale is?
Well,
because I agree with that.
Yeah, maybe. Yeah. Or just like it's cyclical, right? That if you were a genius, you were short Nvidia and Tesla and Meta in 2022, and then on December 30th, you covered your shorts, you got max long and Gen 123, and your logic was, well, they're closer to the end of the hiking cycle in the beginning. So as your early phase of the cycle, you anticipate the accommodation and it's bullish for multiples. And we track, of course, the statistical significance between Fed Fund Futures 24 now and the price of forward earnings of growth stock. You could track that, okay? Mm-hmm. Then, now aren't we 4 years later now? And you're like, okay, well, if they start cutting here, well, you got to be closer to the end of the cutting cycle than the beginning. It's like eventually tightening is coming. Like it's more like the market reaction to it. And if they're really doing it, it's probably because like earnings or maybe the economy, which like maybe they're just getting bad enough that you're not like psyched they're doing it. So I think it's like a different interpretation at this point in the cycle, I guess. But in the end, I think it's the same thing you said.
Well, this is great stuff, gents. I hate to start bringing this to a close. A few quick questions, and I'll ask you guys where the audience can follow you and your work. A couple of questions I'm just going to collapse into one general one. A lot of interest in gold. Folks are wondering what your outlooks are for gold. So, Adam, why don't we start with you?
I like it. I think it all changed in the Ukraine war. When we froze, the U.S. froze foreign country reserves, and every other country looked around and said, well, I can't afford that to ever happen to me. And so there's going to be a lot of structural buying. And, there's times where it looks correlated to AI and times it doesn't and all that. But I like it. Now, old school people would say there's no cash flows and whatever. Mm-hmm. So, I'm not saying you own 100% of your assets in it, but, I don't mind somebody who's got, $20 million owning $1 million of gold or whatever, a few percent allocation I think is interesting. And I think it probably is, it could be 6,000 or 8,000 in 5 years. And I don't mind that because I don't think it's exactly the same as a data center build out.
All right. And Michael, how about you, my friend?
We're 6% precious metals right now. The reason I can go as high as 20 in the portfolio. The reason why we're not longer is because gold loves falling real interest rates, falling nominal rates. You're just not getting that right now. So I have to see a sharp slowdown or at least a significant slowdown in economic activity before I would increase the position. But there are structural central bank buying.
How does that square with your inflation view? Like if you're right that inflation is skewed to the positive, isn't gold decent for that? Or how do I think about
Well,
that?
because gold doesn't care much about inflation. Inflation can be very damaging to gold. It just depends on the level of real interest rates. Right. So if nominal rates are rising faster than inflation, then your real interest rates are rising, and that's not good.
So I bought, full disclosure, I bought all mine that I've owned the day after I read that UBS money market accounts were backed by auction rate securities in 2008. So wow. I've never sold it. I probably won't. I guess my bull case is when I die, there's like a shoebox with each grandkid's name on it. And it says,
it better be a strong shoebox.
Think of me kindly, something like that.
Yeah.
Wow. Gold. Yeah, I said 5%. He said 6%. So I don't think we're that different.
Yeah, I'm just trying to do the math. In 2008, it was what, like 675, 700?
No, I think it was like 1,200 when I bought it, something like that.
Was it? Okay.
I bought a bunch of silver at like 12. The only thing that's been crap is I bought a little bit of platinum too, but like it was just more of like this doesn't. How does UBS tell you had $1 in there today and it's 92 cents tomorrow? It like melted my motherboard. Yeah, the cash was the cash, So whatever, I did it and whatever. But I think it's a sensible allocation at mid-single percent.
Yeah. Well, it's actually Adam hat tip to you, Mr. Parker, because gold has been a better performer than the S&P 500.
Not since I bought it.
In 2000.
But since 2008 or 9 it has. But it's diversified. I don't mind having it. It's shiny. You look at it, it's nice. But like I don't think it should be 20%. Something mid-singles.
Well, it depends on the economic situation. It would only be 20% as we enter into a recession, because everything goes to a correlation of 1 eventually, and everything gets sold.
Yeah. One of the challenges like institutional investors have right now, for sure, is like how to get defensive, right? Because the traditional defensive stocks, when we were formulating our investment heuristics, were things like pharma, telco, staples, whatever. But they've been missing more. So they're not really providing any defense at all. And the defensive market cap is really small relative to the offensive market caps. You can't even like equilibrate it, right? So it's sort of been like, the traditional way to do it is buy low beta, buy narrow estimate dispersion, look at what worked in prior downturn. Like all that stuff has not been a super instructive way.
So there's only 4 things, Adam, that work in a recession, and that's cash, T-bills, long the dollar, and shorts. Those are the only 4 things that will work.
Right, but a chunk of my clients, more than half, are long only fully invested S&P 500 managers. So they got to like reposition within the book to beat the index.
Yeah,
and I in that light, but I hear you on that.
Yeah.
All right, well, look, gentlemen,
you're an interesting guy, Michael. We should break bread at some point.
Okay, I'll meet you in the middle of Alligator Alley.
In Alligator Alley, right? Yeah, one of those boats go with the fan boat. Meet on a fan boat. Yeah.
I was going to say, you guys don't live that far from each other. I think you should definitely make that happen. And I want to thank you, gentlemen. This has been a wonderful conversation. I'd like to give each of you the opportunity just to sort of deliver any wrap up that you'd like to the audience, and I'll just give you a slight bit of guidance on that, which is, what would your parting counsel be to today's investor, watching this program and just trying to position themselves for success with an acceptable amount of risk management going forward? Mr. Pento, let's start with you.
Well, I guess we'll end with a disagreement with Mr. Parker. I think it's more important now than ever to be with an active manager that has a robust model, because the dangers, as I presented very clearly, are evident. Getting the timing right is everything. And like Mr. Parker does agree, everything goes to a correlation of 1. You have to be in T-bills, cash, dollar, and shorts if you want to protect and profit from the next recession. Not if it happens, when it happens. So I would suggest you get involved with an active manager with a robust model. Of course, that's self-serving, but it's mandatory that you do so, in my opinion. If you like what you hear today, you can subscribe to my podcast. It's the Midweek Reality Check. It's $50 a year with a 5-week free trial. It gives you my high-level view of the economic salient economic data of the week, and a high-level view of the portfolio. And if you're qualified for a long-short strategy or a U.S. citizen, $100,000 to invest or more, I will manage your money directly in the inflation, deflation, and economic cycle portfolio. The website is pentoport.com. And thank you both very much for the opportunity to be on your program. A lot of respect for both you gentlemen.
Well, right back at you, brother. And Mr. Parker, how about you?
Yeah, no, thanks. It really was a pleasure. I think I don't disagree with what he said there either. I just said in the equity portion only, but you need someone to toggle between the asset classes, and I think a lot of what he's suggesting makes sense. Within the equity part, if 90% of the people underperform, then maybe for the average person, they shouldn't spend a lot of time picking their own stocks, because it'll be hard for them. There's a lot of smart people with big computers and big budgets, and they can't outperform. So I think a lot of people shouldn't be trying to do it themselves. And I would probably be, focused on taxes and fees and other stuff. Our core business, Trivariate Research, is really a product set focused on institutions that pay us, multiple 6 figures for the products. But we have a business where we sell to individuals and advisors a newsletter, several pieces a week, weekly videos, and then also monthly Zooms like this where people ask me questions. We do ETF analysis and the like. It's called Trivector Research, TRIVECTOR. Trivector Research. The idea behind the tri is macro, quant, fundamental, applied to equities. That's what my whole background is. It's $110 a month or $1,200 a year subscription. And we'd love it if people went to Trivector Research and signed up. And then you could also, I just joined X last week. So that's Adam_Parker_Tri if you want to see what we do. And also on LinkedIn, we publish, put a lot of stuff on there too. So, really a pleasure. I didn't know what to expect, but this was really fantastic, and I appreciate you guys including me, and great to meet everyone.
All right. Well, very happy you were able to join. Big thanks to the folks at Zero Hedge for producing this and putting this all together. It's been my honor to be the moderator here tonight. Definitely, folks, go and investigate both Adam and Michael's services there. And I can't recommend either enough. And if you want to see more deep discussions like this about all sorts of macroeconomic issues, feel free just to come over to thoughtfulmoney.com, and you'll find all of our media services there, as well as some financial solutions that we try to put in front of investors who want to take action based upon what all these experts are saying. Michael, my friend, so great to see you again. Adam, really nice to make a new contact here. Really look forward to seeing both of you in the future.
Yeah, me too.
God bless.
All right, and everybody else.